These are some undervalued stocks that you must own. I'll be ranking stocks that I don't own based on the valuation as well as the mode of the company itself. So the first stock that I'll be ranking today is Uber. Uber year today is up around 53%. It is currently trading at a 16 times earnings. So for Uber, the free cash flow is a bit misleading over here. So for Uber, they have a lot of their free cash flow coming from the insurance portion, which is not the money that the company can keep. So if you're to discount that portion away, Uber is actually trading at around a 60 times price to free cash flow if you're to remove the stock-based compensation as well. As for the PE ratio earlier, you saw a 16 times earnings. This is slightly deflated as well because for Uber, they had a substantial amount of their earnings coming in from tax incentives and other investment profits. So for Uber, it is currently trading at between a 50 to 60 times earnings, which is not extremely compelling as well. So for Uber, the other headwind for the company is your robo-taxis. So for example, in San Francisco, where Waymo has been coming in, Uber has seen sort of like a decline in its market share in just a year or so, and Waymo has actually increased significantly in terms of the market share. So if Waymo comes in, if Tesla comes in, if all your different other robo-taxi player comes in without using Uber as sort of like an intermediary app, then Uber will likely see a decline in its market share, which will decelerate the growth of the company. So for Uber, it is an expensive stock that has run up by quite a fair bit already. The company faces terminal risk with robo-taxis. That could be a terminal disruption risk for the company. And if you have to look into the company's numbers as well, the company is not actually trading at that cheap of a valuation. So for Uber, it is currently a company that is overvalued for me, and I don't think I'll be buying into this one. The next company that I'll be talking about is FICO, Fair Isaac. So Fair Isaac year to date is down around 20%. It is currently trading at a 68 times earnings. So for Fair Isaac, they've increased the prices massively over the years. So in 2018, the score actually cost around 60 cents. It is currently priced at $4.95. And over the next few years, analysts are expecting around 20% increase in prices every single year, all the way until 2030. So for FICO, this is both a boon and a bane for the company. It is profitable, it is driving up the income of the company, but the problem with increasing your prices so quickly is that you will face regulatory risk. So the FHFA now allows other credit scores instead of the FICO Classic score, for example. So Fannie Mae and Freddie Mac, now they allow your Vantage score. So this could reduce the market share that FICO currently has and the regulatory moat that was put in place for the company. And so that is the problem with the business itself. It is facing regulatory risk simply because it is too monopolistic. So for FICO, this is my valuation for the company, assuming a 20% free cash flow growth for the next 10 years, and even without adjusting for stock-based compensation, this company is simply priced to perfection. So for FICO, my ranking today is that it is currently overvalued. I think the company is still trading at a premium to its fair value. It is a quality business and this is likely an overreaction, but the company is still trading at a hefty valuation over here. The next company that I'll be talking about is Alibaba. So Alibaba year to date is up around 22%. It is currently trading at a 13 times earnings. But for Alibaba, if you have to normalize their earnings as well, similar to Uber, this company is trading at around a 17 times earnings. So for Alibaba, the story is extremely simple. It's simply just riding on the fact that your Chinese consumer, your Chinese GDP growth is going to continue increasing over the next few years. So for example, your China GDP is expected to increase and go above the US GDP in 2030. And for your China GDP growth as well, it is projected to have around 5% GDP growth for this year and next year. So that is easily a 5% growth in terms of Alibaba's revenue already. So for Alibaba, the cloud portion is also re-accelerating. So your public cloud spending in China itself is projected to grow at around 33% from 2020 all the way until 2025. Ali Cloud revenue grew at around 18% in Q1 of this year, and that was a re-acceleration from the 11% that they had in the previous quarter. So this could be a start of the recovery in your cloud segment in China as well. So for Alibaba, this is my valuation for the company. So assuming a 17 times price to earnings for this company, and assuming an EPS growth of around 9%, so around a 6 to 7% revenue growth, and some buybacks here and there, this company will give you a 15% CAGR over the next 5 years. So clearly Alibaba is undervalued today, and that's why it's in the undervalued category for me. The company can easily generate 7% revenue growth, like it has always been over the past few years in terms of its e-commerce segment. So if the company can continue doing that over the next few years, then this company will give you decent returns over the next 5 years. And that's why it is in the undervalued category for me. The next stock that I'll be talking about is LVMH. So this is actually another quality business that I don't own. LVMH is down around 23% year to date. It is currently trading at a 19 times earnings. So for LVMH, The problem with the company itself is simply just the luxury market slowing. So the luxury market has always been cyclical. There will always be periods of booms and busts, and currently we're experiencing the down cycle in the industry. So for LVMH, this year is projected to be another negative year for the company. LVMH is a resilient business and they'll definitely come out stronger after this. So for LVMH, they're simply the Berkshire Hathaway of luxury. So they own a lot of different brands over here. They own companies like Dior, Tag Heuer, Bulgari, Sephora as well. And the company is basically a luxury conglomerate at this point. So for LVMH, the price to book ratio is actually also trading at quite a decent price. So over the past few years, over the past 5 years or so, LVMH has never traded at below a 4 times price to book and is currently trading at around 3.9 times price to book. So for this company, the valuation now is compelling. The company is in a downturn in terms of its earnings, and so I think LVMH is undervalued today, and that's why it's in an undervalued category with Alibaba as well. The next company that I'll be talking about is GE. This company is a holding by Chris Hohn. Year to date, GE is up around 50% and it is currently trading at a 38 times earnings. So for GE, the company has re-rated because they've been selling out of all the different non-core assets and non-core businesses. So they've sold GE Capital, they've sold their industrial businesses, they've sold a lot of their energy businesses as well, and they've sold out of some of their oil and gas sector. So the majority of the business now is currently in aerospace, the portion where the company holds a significant market share, and the portion that is the highest quality as well. So for GE, they have a large portion of their revenues now coming in from recurring segments. So for example, in GE Aerospace, they saw double-digit revenue, profit, and cash flow growth with continued strength in commercial engines and services. Services represent 70% of GE Aerospace revenue, generally a recurring, resilient, and high-margin source of revenue that will keep us close to our consumers' needs. So for GE, the company's revenues now are extremely predictable because most of them actually come from recurring sources, and that's why we're seeing a re-rating in the stock price itself. So for GE, the valuation currently is quite high. So over the past few years, GE has never traded at a valuation that is higher than it is today. So it is currently trading at a 38 times earnings, and that's why for me, GE is a company that is overvalued. It is a high quality business. For me, I think the price today is a very hefty price to pay. Next company that I'll be talking about is Equifax. So Equifax is currently trading at a 53 times earnings, and year to date it is up around 5%. So for Equifax, this is their business model. They have 3 portions of their business. So they have the US segment, which is your USIS. They have the Equifax Workforce Solution, which is the EWS, and they have the international portion as well. So the best portion of the business currently is your Workforce Solution portion, where they hold a significant market share. So for Equifax, the management is also projecting decent free cash flow growth. So in 2025, for example, they're projecting around $900 million worth of free cash flow. So from 2026 or so, you can expect upwards of $1 billion of free cash flow every single year, which will be returned to your shareholders. So the best portion of Equifax business is your work number portion of the business. So your work number portion of the business has actually a decent total addressable market that it can grow into. And as you can see, only a small portion of the entire market share is addressed today. And there's still a significant market that Equifax can basically grow into. And for Equifax, the work number has incredible pricing power because no other company has the scale that Equifax has. So for Equifax, their work number portion is incredibly monopolistic because government bodies, verifiers, mortgage lenders have to check for someone's employment background, and when they need to do so, the only way for them to get the data is through Equifax. That is the most convenient way for them to do it. And the closest competitor to Equifax is actually 1/4 of Equifax size. For this work number portion of the business, they offer it for free to employers, and in exchange, the employers will give their data to Equifax. So this is sort of like a loop as well, where your employers, they give data to Equifax, and then because Equifax has more data, it will be more appealing to more employers and more verifiers and so on. So for Equifax, around 40% of the revenue currently now comes from this work number portion. So for Equifax today, I think the company is around fair value. I think the company has a decent business in your work number portion, and there could be a lot more growth ahead from here on now. So the next 2 stocks that I'll be talking about is Deckers as well as Lululemon. Both stocks are down massively year to date. So Deckers is down around 50% year to date. Lululemon is down around 38% year to date. And they're both trading at around 15 to 16 times earnings. So for Deckers and Lulu, the problem with the businesses itself is that they operate in an industry that is very competitive. So physical retail is very tough and both companies face intense competition in the space. Lululemon's growth is flat. Deckers still has a lot more growth ahead of it in US. So Deckers is getting hit due to the tariffs. They have factories in Vietnam, but the price of the stock has already been re-rated. So for these 2 companies, if you had to choose between one, I think Deckers is the better company. But of course, these 2 companies are simply just avoids for me. They don't have the predictability that the other companies in this list have. And so for me, I don't think I'll be looking at these two stocks. The last stock that I'll be talking about today is Shopify. So Shopify year to date is around 6%. It is currently trading at a 92 times earnings. So for Shopify, they have a dominant market share in your e-commerce segment. So they hold around 21% of the entire e-commerce market share. And for Shopify, a lot of the small businesses, they prefer to start on Shopify simply because they're able to integrate everything into Shopify. And Shopify has the best interface of all these other companies here as well. So for Shopify, the company has seen rapid growth in terms of its revenue. So revenue has grown at around 20 to 25% over the past few years, even up to around 85% in 2020 as well. And so for Shopify, I think it is a quality business, a sticky one as well, because for small businesses, once they get into Shopify, it is almost impossible for them to switch out. But the problem today is simply just the valuation. It is currently trading at a 90 times earnings, and that is a 3-pack according to its growth rate currently. So for Shopify, it is a quality business, but I think it is overvalued today. I hope you guys have found this one useful and invest safe.